I'm Tyler Jones, Associate Director with Entercom Inc., here to introduce our next presenter, Pipestone Energy. Pipestone Energy is an oil and gas exploration and production company with head offices located in Calgary, Alberta. The company is focused on developing its condensate-rich assets in the Pipestone area of Alberta. Here to share the company's story with us is Paul Wanklin.
Okay. Well, thanks, Tyler. Appreciate the invite to Entercom this year. Thanks to the Entercom group for having us. We're excited to present the Pipestone Energy story as it relates to the Montney play in Alberta, and we're a new presenter here. Although our merger partner, we bought a company called Blackbird last year, and they have presented previously at the Entercom conference. So some of your U.S. investors may be familiar with the Blackbird company. We're located, we've got a very large asset base, 140 net sections in a contiguous block in the heart of the condensate rich trend in Alberta. Merger with Blackbird, was a combination of about 100 sections of their land and about 40 sections of our land, previously the Pipestone Oil Corp lands. Since that time, we've grown our production dramatically. January 2019 is when the merger was effective. We've grown our production from about a year ago, we were 1,500 BOEs a day, and today we're producing about 17,000 BOEs a day. About a third of our production is condensate, and another 10% or so is NGLs. We're very excited. We just recently announced a $70 million convertible preferred financing. It's going to facilitate the resumption of our active development activity or plan that's been going on in the field. We're also excited. Two of our largest investors, and both U.S. investors, participated in this financing, and basically we took down the whole 100% of the $70 million, and that's Riverstone Holdings and GMT Capital, both very supportive shareholders of ours. And I think it speaks volumes to their view of the quality of the asset base, the business plan, and our management team and in general. The financing was done at a pretty significant premium to our current share price, and I'll talk to you a little bit about some of the details in a moment. But the key to the financing is it enables us to kickstart our development program, which was put on hold here due to the price crash in the spring. We're now expected to resume drilling in our project later on this summer, early September. We plan to grow from our current 17,000 BOEs a day over the next 2 years to somewhere in the range of 36,000 BOEs a day. At that time, during that time, we expect to grow our fully diluted cash flow per share by about 250%. So this convertible financing is a critical piece of the puzzle for us. Our banking syndicate is very supportive of this financing for us, and have rolled forward our RBL at $225 million, and now will not be redetermined till spring next year. So really pleased with the support from the banking group. And our overall goal is to generate top decile returns on this asset, top decile for our peer group on this asset going forward. And I mean, we're talking about returns on capital employed. One of the advantages we have, we've built all our infrastructure the past year before we started up production last fall. We've tied all our infrastructure into the Tidewater and the Kira facilities, which are brand new facilities located to the west of us and to the south of us. So we have ample capacity in those facilities to reach that 35,000 BOE day production target. We have our infield infrastructure is sized for that, so all the capital is in place to get to that point. There's minor debottlenecking required to get to up to 40,000 BOEs a day. So we're all set to go. So as we see our plan going forward, we're going to spend approximately $110 million in total capital this year, just over $200 million each year for the next 2 years, and bring on 30 new wells each year for the next 2 years to reach that 36,000 BOE day target. Because 90% of that capital is going into the ground, drilling, completion, equipment tie-in costs, we think that's really differentiates us significantly in that in our goal to generate top decile returns for shareholders. Some of the key placement or key private placement terms. The deal was done. It's a convertible deal. The conversion price is 85 cents a share. Our shares are currently trading at about 57 cents, so pretty significant premium to the conversion to the current stock price. We're if the shares double, the common shares double in the next 2 years or after 2 years, we can force conversion. So at $1.70, the convertible shares have a 5-year life to them, and there's a 6.5% annual dividend paid initially in kind, and then after 2 years we have our option to pay in kind or in cash. Financing will close on September 14th. We've got an AGM scheduled. We need shareholder approval for this financing to take place, and we expect that to be to go very smoothly come mid-September this year. So that facilitates the startup of our drilling program, which will be in September. What are the rationale? I talked a little bit about the scale of our asset. We've got a very highly economic drilling inventory at the current commodity price. Our team has done a phenomenal job of reducing capital costs on the drilling and completion side, as much as 40% since early 19. New wells are generating, in our view, IRRs of greater than 50% and pay out in less than 2 years at a $40 WTI price. We've installed all the infrastructure, which, as I mentioned a minute ago, is really going to help us optimize corporate returns going forward. And we think that you need to be, in our view anyway, as a Canadian producer, in that mid 30,000 BOE a day range with a liquids-rich asset base like we have to ensure sustainability. So there's a pretty big push to get from that 17 up to 36 to 38,000 in the next couple of years. The other, I think, really advantage a company has that's well capitalized as we are is you can actually have a continuous drilling and completion program. Larger companies have that luxury. Smaller companies typically would start and stop, which leads to inefficiencies and uncompetitive future returns. One of the other things that I think highlights this financing and our plan is at the end of that couple of years, we'll be in that top group of Montney liquids-rich producers. We'll be a company that has some relevance, and we will be delevering our balance sheet all the way through to a point where we're probably one of the leading net debt to cash flow in our peer group. The conversion price was an attractive element to the financing. The fact that it's as non-dilutive to our existing shareholders is very important to us, and the execution of this plan will accelerate future per share metrics on a fully diluted basis. So we think all those shareholders who did not or could not participate in this financing will be very pleased with the outcome of the capital spend over the next couple of years. We talk a little bit about our capitalization. I won't spend a lot of time here. If you I'd like to highlight the blue line in the middle. You can see sitting here today, prior to close, we have about $42 million remaining availability on our bank line, our existing bank line. We're drawn about $183 million. With the financing in place in September, we will take that draw down to sub $120 million and have over $100 million, $110 million in availability. Current enterprise value of the company is just around $300 million at today's price. So you can see the company is very well capitalized to achieve its go-forward plan. This is in a nutshell what our plan looks like. You can see the growth projection through 25,000 BOEs a day next year. We're going to spend, as I mentioned, about $200 million a year for the next 2 years. We're outspending cash flow for the first 2 years in this plan. And in year 3 in 2022, you can see we're closely matching our cash flow, so pretty much cash flow neutral. We're running for interest a price deck that's slightly below the current strip. We're running $42 WTI next year and $44 WTI in 2022. So, another key element to this, we plan to, we believe that our maintenance capital requirement at the end of this spend cycle is about $130 million, which leaves us with, $75 million of free cash flow generation after maintenance at the completion of this spend cycle. Net debt, I highlighted again at the bottom. Net debt to last 12 months is 4.5 coming out of this year, based on the very, very low pricing we've unfortunately all been exposed to and low cash flow. But delevers our balance sheet to, we estimate 1.3 times coming out of this in 2022. So we're definitely positioned to achieve scale, and we're pretty excited to get embarked on this next phase of our growth. If we compare ourselves to our peer group in Canada, these are 16 companies represented here, and the list of them is in the footnote. 16 companies are all, basically less than 100,000 BOEs a day of current production. And, where you want to be is in that, top left corner, which is above the average group in organic growth on a per share basis. This is measuring 20 and 21. And you want to be on the left side as far as you can on a debt to cash flow. We're positioned nicely in that top box for 2021. And I believe 21, 22 will push us even further north and west in that box to the best. So we stack up very nicely from our Canadian E&P peers. We look at some of the achievements. I won't spend a lot of time here. We took pretty decisive action this spring in the face of the price crash. We had an original 2020 budget of $150 million. We slashed that down to $60 million. So, we're pretty excited to be able to resume development, and as I mentioned earlier, resume that, towards that. We're actually budgeting $110 million now with our current plan. But I'm gonna talk a bit more about our pace setter costs. Those are really one of the things we absolutely have control over. And our last pad, which was completed in the first quarter this year, or actually in April, so the second quarter, we achieved $5.3 million, which is absolutely our pace setter to date. That's what's driving that 40% cost reduction down from over $9 million 18 months ago. We'll plan on the game plan then this year is to drill 10 new wells, complete 6. None of those wells will be on stream this year. They'll all be on stream very early in 2021. But so that really starts to position us for that ramp up, that first big ramp up in 21 of production. And if we've talked about free cash flow generation, we've also thrown a sensitivity in there. If we do see oil prices heading back towards that $50 range in the next 2 years, then we think we generate closer to $115 million of free cash flow coming out of 2022. Why is this story? I skipped my map. This is maybe to put a finer point on what our development plan looks like. We're highlighting a corner, the west end of our block on the left side of the map here. It's 140 sections, mostly contiguous. We're zeroing in on the area where we have invested heavily in our infrastructure. So you can see there's a north-south gathering system. There's an east-west gathering system. They are actually joined in at the intersection, so we can swing volumes in 2 different directions. We've focused along that system to optimize our overall returns going forward. So what's key here, the wells in black may not show up very well on a viewer's screen, but the wells in black, there's 27 wells in 3 different pads that were added to take us from that 1,500 BOEs a day to 17,000. Over the next 2 years, as I mentioned, we're going to add about 30 wells a year to take us to that 36,000 BOEs a day. The red wells you'll see are laid out. That's our 2020. That's about the second half drilling program laid out there. And then the green wells are wells that we'll be drilling in 2021. And one thing I think I'd like to really point out is that all our pads are set up for 24 wells. So they're all very, very large pads, all tied in. And virtually all the drilling that's going to happen here in the next couple of years is off existing pads. So we're really trying to optimize the returns we're going to generate with this capital we're spending. We really control, capital costs, and it's pretty much one of the critical drivers, as you'll see in a minute on returns. This graphically illustrates where we've come from in that $9 million range down to, well, actually our pace setter well is sub $5 million now. What's caused that? We get a lot of questions about service costs and, if there's return of activity someday down the road, are we going to be hurt by this? A lot of these efficiencies have come through, better planning, the ability to have a continuous program, well designs, cutting and many days off our average drilling, well drilling times, increased or improved frac design and efficient frac design. And then one of the overriding points I should make is our proximity to the nearest big service center. The Grand Prairie town is located right beside our project, and we enjoy the ability to use services, really cheaply, efficiently, all year access. And there's 2 large sand terminals within 5 miles of our existing project. So I think these kinds of cost reductions are in place for us for the long term, and we think we can manage those costs. And our target certainly is to target towards that pace setter. However, we use a $6 million go forward plan in our budget. So we think we've got a fair bit of leeway in our budget, and we're certainly pushing our operations guys to try to institutionalize that, potentially 5 million and under. Maybe to give you just a sense of scope, we pump, our depth of drilling here is about 8,000 feet. We're drilling 1.5 mile laterals generally. We'll be pushing that up to probably close to 2 mile laterals for some of our drilling program going ahead. And we've been pumping pretty high intensity fracs, XLE based fracs, limited entry style, and typically 16 to 1,700 pounds per foot. So pretty decent sized fracs. When we benchmark ourselves with some of our Montney competitors, we stack up as virtually one of the lowest cost operators out there, and at a cost of about $500 a ton of sand placed. So we feel like our operations team is burning on all cylinders, and will continue to going forward. There's a lot of talk about costs. Why is it so critical? On the left side of this chart, you'll see our budget cost of $6 million at a $42 WTI. We generate a well at our half cycle well that pays out in 17 months. If we can continue to duplicate those pace setter style costs, we can drive that payout down by 4 months and generate greater than 100% IRR. And looking at it another way, and potentially a more important way, long term, if we can achieve the same thing after 2022 at our $6 million budget costs, we generate $75 million of free cash flow after maintenance. If we can drive those costs down to our pace setter, that's an extra 25 million or 100 million of free cash flow, and that's run at $44 in 1922 or in 2022. So that's why we're focused on this. We know we have the asset quality, the rocks to deliver, and costs are critically important to us. When we look at our well performance, we normalize here on, this is what you would see in public data in Canada. These are recombined gas rates. So if you pull up our wells on the left chart, that's what you would see in terms of gas rates. You can see we're out to about 240 producing days. To remind you all that we started up the field in last September, so this is all fresh data. These are averages of the 3 pads that are now on stream. So the 2 longest pads are colored in red and blue, 15 to 14 and 3 to 1 respectively. All the pads have achieved very similar, are achieving on pretty much on type curve, I should say, but have achieved very similar CGRs. So we're doing a 2 bench development here. One of the things I want to maybe hit on really quickly is the Montney here is 600 feet thick. There's 4 benches under development in the area. We focused on 2 of them in our initial game plan, our initial development plan, and the CGRs, the condensate gas ratios in those 2 benches are very similar, with the exception of 1 pad. It's the very southwest corner of our land base, and you can see in the cutout box there, we're highlighting that the lower Montney zone in that Montney C, and we actually have a well even lower than that, has averaged about 35 barrels a million of free condensate per barrel in that zone. The rest of the zones range from 82 on a IP90 basis. You can see we're quoting there. And then our most recent pad, 250 barrels per million on an IP30 basis. Interestingly, that 6 to 24 pad, the green pad that you see highlighted here, actually the whole pad averaged 850 barrels per day per well and 3.3 million a day per well on an IP30. So really pleased that we've got excellent quality rock. We know we're achieving great costs. We've got the infrastructure in place. Now the financing to deliver a great long-term growth and I think value proposition for shareholders. This will just wrap it up here. Our overriding goal is to deliver top decile returns on capital employed, and this is how you do it. Because 90% of our capital in the next couple of years is going into the ground, then these half cycle charts really illustrate just how much leverage we have to putting this capital work. So with that, I think that gives you, a pretty good view of what Pipestone's all about, and we're really pleased to be here today and present to Enercom. And our management team is with me in the background. We're going to reshuffle the seats. We'll introduce ourselves and happy to take. We're going to take some questions on a Q&A session. So thank you very much for giving us the privilege of presenting.
Paul, thank you very much for that presentation. We really appreciate having you guys here, and it's a very interesting story. We're excited to ask you a little bit more about it. Before we jump into the Q&A, though, would you mind introducing us to the rest of the management team at the table there with you?
Thanks, Tyler. I'll let the guys introduce themselves, but we've got 4 of the 5 key management members with us here today. So over to.
Thanks, Paul. Yeah, I'm Craig Niebauer. I'm the Chief Financial Officer of the company.
Dan Van Kessel, VP Corporate Development.
Dustin Hoffman, Chief Operating Officer.
Well, guys, thank you all for being a part of this. Again, we really appreciate having you and the Pipestone story here at the Oil and Gas Conference. Just to start, can you walk us through the rationale for the convertible financing and engaging in a growth trajectory? We're seeing a lot of other E&Ps are just focused on maintenance right now, so it's a really unique story, and we'd like to hear a little bit more about why you guys are approaching it this way.
I'll kick it off, and then I'll hand it off to one of the other guys to finish. But you need to have if you look at other companies in the peer group, mostly larger, more mature businesses that have positioned themselves certainly in the Permian or in the Montney play have grown into a position where they can stop and generate free cash flow and try to increase their corporate return generation. We're a pretty fledgling company as a 1-year-old company, and we've invested in the infrastructure. We know we've got the one of the highest quality asset bases in our basin. We know we're delivering top decile returns. Our drilling efficiencies. So our management, our board, and our key investors believe that this is the right time now to grow into a sustainable business model. And that's where we see ourselves in 2 years. So maybe I'll pass it over to one of the other guys.
I think it's important for a lot of US guys to understand that condensate in Canada is one of the very few products that trades at world price. So condensate is traditionally traded very close to WTI. There's going to be a shortage of condensate in Alberta because of the lack of activity. Condensate is used to be mixed with the heavier grades of bitumen to move that bitumen. So there's a real demand locally for that product. It's actually imported into Canada, which is something that a lot of people probably don't know. So when we did our economics, we have really improved our capital costs. We have great rock. We are very analogous to most of the Permian producers from an economics perspective, some of the best acreage in the Permian. So for us, $42, $44 oil, we can make a return. So it makes sense for us to grow into the scale that we've already put into the field.
Fantastic. And as we kind of shift into more of an operations question, how do you view the risks associated with parent-child in the Pipestone Montney, and how does the company think about asset capitalization more generally?
Well, let Dustin take that one on.
Sure. Well, I'll start with the parent-child issues and that play. And, one of the things that's a little bit unique to Pipestone, we've spent a lot of time and effort designing our XLE, or extreme limited entry completion model, around a very, very high efficiency of cluster performance. So, we've done a bunch of diagnostics on our recent pads that's telling us that 80 to 90% of our clusters are effective and have taken sand. So what that's done for us is it's really helped eliminate a lot of the rogue fracs that you see in other plays that leads to the really detrimental parent-child issues at play. So I think we've done a really good job of kind of designing that away. The other thing that we've done is, we've instituted the larger pad development right out of the gate. So we don't have a lot of legacy production like some of our Montney peers do, where they're going back into pads that were drilled 5, 6, 7 years ago. Because historically, your parent-child interference issues are really those areas where you're going back to offsetting wells that have been on production for multiple years. So we won't have that problem, right? We're going to be able to very efficiently kind of develop our fairway.
We've also had the real luxury of watching some of our neighbors and some of the larger companies as they've overcapitalized some of the acreage near us. And Dustin, being very humble, he comes from Ovintiv, a senior role at Ovintiv, which was formerly in Canada. We brought in other Ovintiv experts and guys from Murphy Canada. So they've spent a lot of time, effort, and capital in the past learning these things, and we're taking advantage of being sort of a newcomer to the party and developing our field with all this knowledge already in hand.
And I heard you guys mention a couple of times the importance of condensate. Can you give me your view on the Canadian condensate market going into 2021?
Sure. Yeah, absolutely. This is Dan. So you've got a unique situation, as Craig mentioned, in Canada. We're a net importer and have been for the past half a decade of condensate from the US to blend with the bitumen production from the oil sands and get it pipe spec to ship out to the US and other international markets. Demand last year peaked at about 750,000 barrels per day. We only produce about 450 to 500,000 barrels a day domestically. That is declining as a result of the lack of capital coming into the space. The base decline for condensate in Canada is anywhere between 20 and 30%. Without adequate capital being spent, we just have a shrinking supply base. The oil sands, on the flip side, are very low decline in general. You could characterize them as, call it 5% annual decline. Many companies shut in their projects due to the extremely low pricing in Q2, and they're able to bring those projects back on virtually to the same production that they had before. So that mismatch in the supply profile for the condensate domestically and then the demand profile of the bitumen creates a situation where we think we're going to need more condensate than can be imported. We've got two pipes that import condensate into Canada, Southern Lights and Cochin. Combined capacity is 275,000 barrels per day. We were hitting that maximum consistently at the beginning of this year, which was resulting in premiums to WTI. We look forward to call it a par price with WTI in 2021, but it's completely there's a great chance that with continued strengthening of WCS prices being the oil sands price that they receive, that we may be in a premium situation again in order to incentivize new condensate supply being developed.
Well, that sounds like a really enviable position to be in as far as the pricing you're getting on your production goes. I wanted to jump back a little bit to that number you had provided to us on the reduction in your well costs. I have to imagine, with the premium you guys see on your production in combination with those lower well costs, it puts you in a really great position. Can you just kind of walk us through in a little more detail some of the initiatives that have resulted in that 40% reduction in 2019?
Sure, I'll take that one. One of the key things, and Paul alluded to it in his presentation, that going to some scale and having a fairly continuous program is definitely key to driving costs because it allows you to drive some efficiencies. But I usually break things down into a couple of buckets that we've really focused on over the last number of pads. The first one would be scope. So we've made some modifications to our wellbore construction in that how we drill our wells, which has allowed us to really shave a number of days off the drilling times. The other key piece for us is a focus on efficiencies. So the larger 6-well pads that we've developed, the last 2 pads, we've ran 2 frac spreads on each of those pads. So a very large operation, but what we've really focused on is getting our frac efficiency up to a very high level. So we've added 2.5 hours of pumping time per day from our first pad to our 4th pad in this development cycle. And we still think we got a little bit of room to go, but that's been a huge win for us. Is the shorter the amount of time that you've got your frac services and all the associated equipment on that lease, the cheaper your well costs are going to be. So the beauty of what we've focused on so far is it's been somewhat independent of service costs. A lot of the efficiencies and the changing how we're drilling our wells, that doesn't go away. So we get an increase in commodity prices. Understandably, some of the service companies would want to increase their margins, but thankfully, all these wins that we've got to date, they don't disappear. So we're pretty confident that we're going to be able to deliver on these pace setter well costs that we've already demonstrated.
Well, guys, thank you so much again for coming to the virtual oil and gas conference this year. Really appreciate having you be a part of this event and sharing the Pipestone story with us. So thank you so much again. We hope that you'll join us again in the future.
Thanks
so much.
Great having us. Yeah, thank you. Great to be here.